Welcome to Introduction to Business 121 online, offered by the College of Lake County. My name is Dr. George Mochocki. This course is in conjunction with Blackboard Course Management System and McGraw-Hill Connect and LearnSmart integrative software from the publisher. Okay, this week we'll be covering 3 chapters. We're going to start off with personal finance, then we're going to work into accounting, that's chapter 17, and we're going to work into the chief financial officer. So let's start off with the first chapter, personal finance. If you understand your own personal finance, what do you do every day? You buy coffee, you pay your bills online, you borrow money, which would be considered debt financing, or you sell some personal property, which would be considered equity financing. You look at different ways to reduce your tax burden. You look at you record your budget. You have a what do you call it? An expense account. You write checks. You have savings account. Everything you're doing now, you have an individual retirement fund. Everything you're doing now in a personal finance is the same conceptual ideas that you will need when you're doing accounting and when you're basically going to do the next chapter, chapter 18, chief financial officer. You are basically the chief financial officer. So let's see what we're going to talk about this week. Personal finance. If you understand your personal finance and how you're thrifty and manage money is a good indicator how you'll be able to manage a company or manage a budget or manage a department. So where do you get your advice from? And most people in personal finance will get advice from your friends, your family, your banker, your insurance agent. Remember, when you're getting advice from friends, if they don't have a penny to their name, or they drive a raggedy car, or the creditors are calling them, that individual may not be the best individual to get advice from. Try to get someone who is tight with their money, controls their money, has a lot of money, watches every penny, and knows how to make money from the money that they have. Well, like a farmer, they plant seeds. Okay, so you look at personal finances. They're going to look at 6 ways to control finances. You know, you look at your expenses, same thing you need in a business. Prepare a budget, pay off your debts first. So you're always looking when you're paying off your debts if you get extra cash. If you have a charge card for 13, 14, 15% interest and you get $50,000, pay off that debt first. Don't put the money into a bank or a CD that's only paying 2 or 3%, because the expense or the burden of the debt to manage that debt is higher than what you're putting the money away from, putting the money in from a savings account. Okay, household budgets. Look at how you manage your rent. Same thing in a business. You learn how to manage. Look at your cash flow of business. How much budget. Most business, when you look at a budget, they're looking at cash flows. How much sales is coming in? How much accounts receivables are coming in? You track your budgets right now. You could use QuickInt or a lot of your online your smartphones. You will be able to categorize where your money goes, and at the end of the month, see where your money goes. Is it going for car expenses? Is it going for pleasures, going out a lot? Is it going for eating? And then once you understand your budget, where could you cut the budgets and where could you use some of the money that you're cutting to pay off debt or to make more money with that money? Savings and managing credit. Look at credit cards. There's no way around it. You have to have credit, even in business. I need to have credit, short-term credit, or loans basically to buy my inventory. I need credit to buy a car. I need credit to buy a house. I need credit to reinvest. So in a personal aspect, you'd have to charge, but you don't need to charge to have a McDonald's. You need to charge just because I'm feeling lonely or feeling sad, and you're going to just buy just for the pleasure of buying. When you use credit in business, you use it wisely, and you use credit to make more money off that credit, or to, like, if you student loans. How do I pay off my student loans? And basically, it's investing in the future. Okay, so look at the 5 C's of credit. Same 5 C's of credit. Your character, your capacity, your capital, your conditions, or of the terms and conditions. It's basically what finances. All these same things. 5 C's of credit is the same thing how I would look at a business when I'm evaluating a business. An investment period. When you really look at it, you basically FDIC insurance. Look at the high grade mutual bonds. It's good investment. Look at how you balance your portfolio. All of these, they'll talk about individual IRAs, individual retirement accounts, or in a root account. Make sure that when do I pay taxes? Do I pay taxes now, or do I pay taxes later? Make sure you understand what annuity is. So that's all basically. An annuity is based is compound interest in your favor. Same kind of compound interest that you're paying in on your credit cards, only in reverse. It's so you put a little money now, and by the time you're 60, 62, if you only put away $500 or $1,000, you have more than enough money for retirement. Okay, so that's your personal finance. The next chapter we're going to go into is chapter 17 is accounting. Now, accounting, if you look at accounting is the basic numbers. This is actual numbers. Accounting is the language of business, and the reason is because of the language of business, because we're looking at the finance. In accounting, I have to know my expenses. When I look at accounting, they have different aspects of accounting. So let's start off. What's accounting? They have inside parties look at accounting and outside of parties accounting. Let's say accounting has input. So you go to the bookkeeping. It's tracking all your expenses, all your money coming in, everything else, so you know how much money you have. Whether you have a profit, do I have a net loss, or you have a net gain. So now when you're looking at accounting, so it's taking the money and it's looking at bookkeeping. Bookkeeping is either putting in the right journal, putting in the right ledger, and then at the end, it's looking at different statements. So what you'll have is in accounting, you're looking at three major statements. Your income statement, so it tells me how much money is coming in and how much my expenses are. My balance statement tells me how much do I owe, what's my liabilities, what's my net worth. If I look at how much do I owe and how much capital do I have, so I look at the balance sheet. It tells me my expenses and my capital versus my liabilities, which gives me my net worth. Okay, you're looking at auditing and accounting. You have different auditing. Auditing is a small portion of accounting, but it's important so when stockholders or investors or even the governments or your employees are looking at your books, either because you're saying I don't have enough money to pay you, or I have more than enough money and I want to invest into another market, and the stockholders are looking at it, or new shareholders want to buy into the stocks, the initial public offering that the company is going to be offering. So that's all accounting. So it gives me an annual report. It gives me a balance sheet, which looks at assets, liabilities, owner's equity. Income sheets look at the revenue versus the statements. And then your the last income statement, the last statement, financial statement that I need is my cash flow. If I look at most businesses, they got a good idea, they got good investments, they got good money, but they have a poor cash flow. Just like a lot of us, we have a lot of the items we own, we balance a lot of things, but once in a while, when we don't have the cash flow, we're short. That means our bills are going to be late, we can't pay our creditors on time, or we don't have cash to buy inventory, or we don't have cash to fix the car, and that could give us a spiral effect where all of a sudden we start falling behind, which hurts our credit score. Like we learned the 5 C's of credit: the capacity, and the conditions of the credit. Okay, so look at the cash flow. Basic terms, make sure you know what FIFO and LIFO is, know what depreciation is. It's an economic term, basically that you could write off a certain amount of assets. In the long run, after you write off, you no longer have a tax break, and because you don't have a tax break, you'll buy another investment. There's nothing wrong with that asset, but you no longer have any tax write-off. And then in accounting, you're looking at the different ratios and different expenses and different tax write-offs to see how much profit or loss I'll have over it. Make sure you look at the ratios. There's a bunch of ratios that you have to be familiar with. Your liquidity ratio, your current ratio, your leverage ratios, your profitability ratios, activity ratios, inventory turnover. When I'm looking at the ratios basically make sense only for the industry. So if I'm looking at the car inventory turnover of cars, so maybe I'll turn over 4 cars a month, which is very good for that inventory, because it costs me a lot and I only have so many people buying cars, and that turnover for a car dealership is excellent. Now, if I look at that 4 turnovers and I'm selling vegetables, and I got tomatoes, I got bananas, that turnover is very terrible, because if I only sold 4 tomatoes or bananas are going to be stale, old. So you have to look at the ratios. All the ratios, when you're looking at the various ratios, you have to compare them with the best in the industry. So when I'm benchmarking, ratios have to be apples to apples. So if I'm looking at the ratios for Walmart, I'm going to compare it to the ratios of Target. If I'm looking for the ratios of let's say Blockbusters, I'll look to the ratios of Netflix and maybe a home video. Family video. All right, so that takes care of chapter 17, accounting. Now, the last chapter we're going to talk about is chapter 18, and that's finance. Now, finance is basically taking all the chapters together, and now look at accounting as a scale. I look at the scale, here's how much money I make, here's how much my expenses are, here I'm either broke, or I'm making money, I have extra money, here's what it is. It's a snapshot. This is what it is. This is what you have right now, George, just for accounting. Here's the raw numbers. Like a scale tells me here how much I weigh. Whether I like it or not, this is what the scale says. You weigh 180 pounds. Now, if I look at finance, chief financial officer, he'll take or she'll take those numbers and he'll try to make those numbers better, improve the profitability, improve the liquidity ratio, improve the inventory turnover, improve the debt to capital ratio. So if I'm looking at what finance does, it's taking what accounting does, it changes them. It's like a dietitian. Here, George, you weigh 150, 180 pounds. You should weigh 165 pounds for your weight and everything else. I go to the dietitian. She tells me do this. After 3 months, I go back on the scale, and the scale says, yes, you've dropped in weight. So the course of action the dietitian has told me is working. Same thing with finance. The course of action of the chief financial officer, when he or she is telling me to do this kind of maneuver within my financial status, either sell or increase my accounts receivable through factoring or other things, either to buy or sell more or offer initial public offerings. That means sell more stocks to improve the bottom line. Then, and when I go back to accounting to look at the numbers, the raw scores, the ratios, this is what it is. So what you're doing, George, as a chief financial officer, is paying off. So what you're looking at, so that's the chief financial officer. What does finance do? Why do most firms fail? Most firms fail because they're undercapitalized or in a poor cash flow. They don't have enough money to sustain in the rough times. Like right now, the economic condition, the customers aren't there, so I have to at least make payroll. I have to pay my rent, so I should have some retained earnings or some money left aside. I have poor credit, so now I don't have a line of credit, so I can't buy my inventory now. I need a short-term loan to buy my inventory so I could buy it, sell it, and then basically pay off the short-term loan. So now who's in finance? What are some financial controls? And you look at variances from your accounting. What's my last year's sales? What's my last year's projection? What's my last year's profitability? And how close I am at now? And if I'm not there, if I'm really failing or not achieving the goals that have been set, or at least make the goals from last year, what am I going to do differently? Am I going to have sales? I'm going to increase my marketing expense. This is all the decision the chief financial officer has to do. If I'm running short of cash, do I use a trade credit, promissory note, to friends and family? What are the commercial banks? Will they give me a loan? What is the line of credit? Factoring is basically selling accounts receivable at a lower cost just to get the to improve my short-term liquidity. What's commercial paper, credit cards? Know the difference between debt financing. That means that I either issue IOUs or bonds, or I take out a loan, versus equity financing. That means I basically sell stocks, or I sell some property or sell a portion of my business and get cash for it, so I don't have any loans. It's almost like having a garage sale, for lack of better words. Know what an initial public offering is. Make sure that you understand finance securities are both looking at stocks, and they're also looking at bonds, which is a step style. The 5 C's of credit against capital, character, everything else falls over here into this chapter. Okay, so that takes care of chapters 18. So we got 3 great chapters. So we're going to do that. This week you have one McGraw-Hill Connect is going to cover chapters 17, 18. Worth 20 points. Worth 30 points. To make everything whole. You have one regular test on quiz on Appendix D, and that's worth 20 points. 10 questions, 2 hours each. More than enough time. And each question worth 2 points. This week you have one form. What you're going to go in a form, you're going to look about credit cards. Understand what's a good credit score. Look at student loans. So what are the difference between a governmental loan versus a private loan? Look at borrowing credit cards. How many credit cards should I have? How do I improve my credit scores? Is bankruptcy an option? What is the credit scores for a business? Is it the same kind of requirements and rules? Provide these and others, how to get out of short-term debt. What is some kind of advice? Everything about credit, whether it's personal or business related. Just talk about it, throw it in. Find the websites. You find some different kind of website about credit scores, about how to improve your credit, about credit cards. Post a website so other people could share that website, and then you will discuss. And look, this is a good chapter. Credit is something that we all are in need of. How do I stay on budget? How do I keep my expenses? How do I pay off debt? Is it a good idea to take a second mortgage? Is it a good idea to pay all my credit cards in a home equity loan? How do I get a credit card? How many credit cards do I need? So basically that takes care of this chapter, and we should be doing good. Look, next week we're going to be doing strictly on your feasibility study. So this chapter, go at least this week if you got a chance, go into Blackboard, look under your feasibility. You have a quick YouTube about me. It's a little boring, but it'll give you the general idea. Try to smile a little bit. You have a PowerPoint presentation I created for you. Have a real short PowerPoint, and you go to the next one is more in depth PowerPoint. You have the concept map, so you should basically have everything you're ready. So keep on working on it. In a couple of weeks, you'll be finished, and this class is going right at it, and then you'll be enjoying your semester break. Okay, my name is Dr. George Mochocki. This week we're covering Chapter D, is personal finance. If you understand personal finance, you'll understand business finance is just a lot less zeros, but it has the same concepts, the same ideas, and one of the vocabulary is a little different. Then you're going to do accounting. Make sure you know the difference between input, output, LIFO, FIFO, depreciation. Make sure you know about auditing, managerial accounting. And then the last one we have is chapters 18 is on finance, chief financial officer. Make sure you understand what a finance is. It's a little different. If you don't like the accounting because it's very rigid and everything else, you don't have to do the accounting numbers when you're finance, but you have to change the outlook of the financial health of the organization. That's what the chief financial officers do. We're all doing that every day in our daily budgets and everything else to change the output and financial status of our own personal life. And now you take the same skill sets, the same integrity, and the same ideas and creativity, and you using this for your business venture, for your feasibility, or ideas, or at home. All right, my name is Dr. George Mochocki, Introduction to Business, covering chapters D. Chapter on personal finance. Chapter 17 is on accounting. Chapter 18 is chief financial officer with the College of Lake County. And I'll see you in our forum on credit. Bye.